Hello and welcome back to the Project Management PrepCast, your cost-effective way to prepare for your PMP exam. I'm your instructor, Cornelius Fichtner. Yes, the focus of this lesson is a number of advanced theories and concepts from cost management that are not necessarily discussed in the PMBOK guide. So in this lesson, we make sure that the nuances of the business language relating to cost is understood and dive a little deeper into cost classifications. This includes an overview of indirect, direct, variable, and fixed costs. But our focus is understanding how costing is used to determine various alternatives. As was mentioned in the core lesson on estimate costs, costing is a process of choices between various options to minimize the cost and maximize the value. And so we help you do this by discussing some of the more esoteric theories on opportunity and sunk cost, including how they are treated and used in evaluating options. We also discuss the effect of mandatory and discretionary costs on projects, and we wrap up this lesson by garnering a better understanding of value. We put on our thinking caps. There is a lot to cover. Remember, though, that the most important part is understanding the concepts themselves and how to make appropriate decisions for your projects. This is such fun material that it takes a little time to cover it all. Therefore, we have a two-part lesson. In part one, we cover the financial language so that when talking with financial folks, you understand what they are saying. We look at cost types and how they work together and explain how to determine and use opportunity cost. Then in part two, we sink our teeth into sunk cost. We talk about discretionary costs and explore business value. So, put on your thinking caps and we can impart some value. The main concept behind this lesson about advanced costing is that costs are incurred even when you do not have to pay an invoice, write a check, or transfer funds. And although you have people, tools, equipment, material, and other tangible items that you need to purchase for your project, don't forget that there are many costs that are not so directly obvious. There are many items that are indirectly related to your project. Some costs are so indirect that you can only estimate what they might have been had you made a different decision, and other costs are necessary but fail to contribute little to the assets of the company and are lost forever. In short, there are a number of arcane topics that may take a little extra thought. In our journey to better understand costing, we need to ensure that we are talking the right language, that of accountants. Sometimes it can be confusing and even ambiguous. Accountants and business people use many shorthand notations, and at times they can be puzzling. Denoting negative numbers is one such example. Negative numbers have three common representations. The easiest is to simply put a negative sign in front of the number, a little dash there. However, these negative signs can easily be overlooked. Therefore, in some parts of the world, it is common to put parentheses around a number. These are not the parentheses that you see in an equation. These are parentheses around a financial number, like you see here. Other times, people use the color red. Red often denotes something is in trouble, which is usually the case when you have negative numbers. Each of these three examples here means minus 10,000 US dollars. Especially for me, coming from Europe, I had never seen option 2 before. It seems to be something that is done here in the United States. So I had to learn, parentheses around a dollar number means minus. That was brand new for me. We also want to prevent potential confusion on the abbreviation of PV. On the one hand, PV stands for present value, or the term to refer to what something is worth today. This is the same PV, present value, used in the acronym NPV, net present value. On the other hand, in control costs, we have planned value, which is also abbreviated as PV. This is part of the earned value management methodology, and it denotes the planned costs at a specific date on your project. The good news is that PMI is not going to try and trick you by using one PV and meaning the other. But you need to understand the context in which PV is used, and it will become immediately obvious which of these two is meant. When people are dealing with larger numbers, most do not want to write out all the zeros and thousand separators like commas and periods and apostrophes. Values are often abbreviated so that 1000 can become 1K or 1M. 1K stands for 1 kilo, as in 1,000, and bankers, often older bankers, they use the capital M. And this comes from the root mil, as in millimeter or millennial, and both of these relate to 1000. A friend of mine related a story about his shock when he got his first business credit line. What he thought was $30 million credit limit, well, turned out to be $30,000 of a credit limit. Which brings us to the notation for 1 million. Well, you can represent 1 million by using 6 zeros, or you can say it's 1M, and again, you can now easily confuse this with 1000, or 1mm, again used often by older bankers. And then lastly, you also need to look for notations in the report headers or footers for statements, like the numbers are in thousands or the numbers are in millions, to tell you the magnitude of the numbers. If you're used to working on projects and you see a number like 35,000 euros, make sure that it means 35,000. That there is not a footnote saying it's in thousand, meaning that the number is not actually 35,000, but it's 3 more zeros. It's 35 million. That can really mess up your budget. Might feel a little overwhelming until you get used to all these various notations. And then we cannot neglect the characters used for separation of thousands and the decimal character. Here you see 4 possible notations used around the world. The first one uses apostrophes to separate the thousands and a comma for the decimal separator. The second uses periods to separate the thousands, and again a comma for the decimal separator. The third uses spaces and a comma, and the last one uses commas to separate the thousands and a period for the decimal separator. The one you have to get used to for the PMP exam is the last one. That is because PMI is in the USA and they use the notation that is common here and in the UK. The comma is used to separate thousands and the period is used to indicate the decimal separator. There are also a lot of words that we need to add to our vocabulary. In estimate costs, we learned about 4 different cost types: direct, indirect, fixed, and variable. So this table may look familiar. In this lesson, we're going to explore them now in more detail, along with their relationships, and then add a few more terms. These first 4 terms, fixed, variable, direct, and indirect, are not entirely mutually exclusive. Fixed and variable costs can be either direct or indirect. Indirect fixed costs are items that do not change, regardless of how long you run the project or the quantity of its output. And they are not items that the project gets directly. Examples include costs that benefit multiple projects. Some organizations, they charge a fee to set up the project. Some salaries can be indirect fixed cost, although administrative salaries are charged periodically, say monthly, and the total cost of the project increases the longer the project is run. The monthly charge is a fixed amount. Indirect variable costs are items that change based on how long the project is run or how many products you make. These often come as support services costs that change based on the number of people on your project or number of invoices issues or burden rates that fluctuate with the quantity of products. In addition, there might be fixed costs that become variable. For instance, administrative salaries that change based on the total hours used. Maybe once you hit a threshold and you are charged more, or you get a volume discount. Direct fixed is more common when you start a project. Direct means it directly applies to the project. An example is when you pay for an item once and it applies for the duration of the project. These are usually not items that go into the product, because if something is included in the product, the cost would change if you made more of that product. Desks, software licenses, hardware, manufacturing jigs, and tools are examples here. Direct costs usually only benefit one project. Yes, direct costs can also include some salaries. Many people on the project team can be salaried, and those are directly charged to the project. Lastly, direct variable costs are quite common, as these are items like labor, which changes with the number of hours that a person works. Travel, as it depends on how many trips are taken or how far you go. The material, which changes with the quantity of items produced, and usage of physical resources, such as hourly and daily rates for equipment. Anything that the project pays for can change with duration, used, or quantity built. For example, assume your company runs projects to build custom dining and coffee tables, and you have started a project to build a custom dining table for a movie star. The cost of the wood used for the dining table is a direct cost. 100% of the costs associated with the wood can be traced back to that particular dining table. Another way of saying this is that the wood is 100% allocated. It is a direct fixed cost because we are only doing this one table. The cost to rent the warehouse where the tables are produced, though, is an indirect cost and needs to be proportionately allocated to the different projects that are conducted in that warehouse. If 50% of the warehouse is used to produce these craft dining tables and 5 projects can be run at a time, then 10% of the total amount of monthly rent must be allocated to the monthly cost of your project. If your project takes longer than anticipated, more rent is allocated. This is still an indirect fixed cost, as it does not change. The hourly labor to build the table is charged directly to your project for each person when they work on your table, as it applies only to your project. It is direct. Since the number of hours is only estimated and could change, they are variable. It's a direct variable cost. However, there are accounting and legal staff that help the company run, and your project has to carry the burden for some of these costs. The company decided to charge a certain amount of these people's time to your project based on the number of hours you bill. The concept is that the more hours your people report, the more work the accounting group has to do. This takes care of their time in ensuring billing, time cards, payroll, payables, invoicing, and all is done per company standards. This means that you, as the project manager, you do not have to do this, because these folks are not working directly on your project. It is indirect, since the charges change with your project's other variable costs. It is variable, indirect, variable. There are a few other types of cost classifications we need to know. They are often used when determining the value of a project. They are sunk, opportunity, mandatory, and discretionary costs. Any of the costs that we have already looked at and talked about so far can have these additional classifications. So, in brief, sunk costs are spent funds. Opportunity cost is the value of an alternative option that you did not choose. Mandatory costs are funds that you must spend, and discretionary costs, sometimes called discretionary spending, is money that you spend voluntarily. It is the opposite of mandatory. It's important to go through these in more detail so that you understand them, and we're going to be using examples, so that should help. Here's the basis for the example we're going to use. Assume your company wants a new disaster recovery and continuity site. This means that if there is a major disaster, flood, fire, earthquake, and so on, your corporate systems can switch over to those secondary systems, and the company would only be out of commission for a very short time. Your executives look at two options. The first one is to build your own facility in a remote area near a hydroelectric dam, and the costs are estimated to be $300,000 to build the building. Buying and installing computers costs $250,000 in hardware and $200,000 in labor. Installing specialized software for running your business has two components. The software costs $360,000 and labor to install and configure it at $300,000. Pulling in special power and data services costs $85,000, plus a 5-year commitment to buy services is $4,000 per month. Staffing costs are at $18,000 per month, and it would take 9 months to get the data center operational. The second option is to outsource the data center operations. There was a technical review, and the best outsourcing options is a vendor with a one-time setup fee of $150,000, and it cost $37,000 per month with a 5-year commitment. Having one of your people manage the vendor costs about $5,000 a month, and the vendor would have services available in 4 months. The 5-year cost total is $2.67 million US. To make the initial decision, your company used the 5-year cost model, ignoring depreciation and interest. Here they are. Building it is on the left, outsourcing is on the right, and you can see that the 5-year costs for building the data center would be about $2.82 million on the left, and it costs roughly $2.67 million for outsourcing the data center on the right. But besides these physical costs, there is other potential value. If the data center is built and owned by the company, they can garner some publicity because they are creating high-paying jobs in that rural area where the data center would be. The impact to the community would be huge, and the residents are more likely to buy your products. You think this increase in retail activity would generate about $55,000 in profit. In addition, your commercial division can promote the state-of-the-art facility and conduct tours for your corporate clients. This is good marketing, as your competitors do not have this. If you outsource, the tours would not be feasible. This should net another $125,000 in profits. These two additional value items bring the cost down to $2.635 million. Armed with this data, your company chooses to build the data center. Using the data from the data center example, we can now talk about the cost attributes, starting with opportunity cost and sunk cost. Opportunity cost refers to the missed value of other options, and sunk cost refers to money already spent. These two attributes describe a type of past or future cost and lump all the cost types together, regardless of whether they are direct or indirect, variable or fixed. It makes sense to start with the formal definitions. Opportunity cost sounds really simple until you start to reflect on it more deeply. Then it gets really complex really fast. I've seen economists argue about this one. It's not a pretty sight. However, you're not an economist, and we are not teaching you to be one. We are trying to get you to pass the PMP exam and have a good enough understanding of the term so that you feel comfortable using it. The definition here comes from Investopedia. An opportunity cost is the benefit that a person could have received but gave up to take another course of action. Notice the word benefit. It is very carefully chosen, as it includes not just missed profit, it includes value, which is often intangible. Opportunity costs are not tangible costs, as no money changes hands. It is the cost when not doing or when not choosing an option. In addition, it says gave up to take another course of action. This means that these options are mutually exclusive. You can do one or the other, but not both. And to provide you with a slightly different angle, here's a second opinion, so to say. Opportunity cost is the loss of potential future return from the second best unselected project. In other words, it is the opportunity of the potential return that will not be realized when one project is selected over another. Are you scratching your head? Here's an example. Say you had $10,000. You could invest those in Project A for a product that is projected to produce $15,000 in profit in 1 year. Or you can invest it in Project B, projected to net the company $12,000 in profit in 1 year. So if you could do both projects, you would be able to take advantage of both these opportunities. But since in our example you can only do one, you are missing out on the other opportunity. In other words, if you go with Project A, you are missing out on Project B. And if you go with Project B, well, you're missing out on Project A. So, if we consider the opportunity cost of each choice, the opportunity cost for choosing Project A is the $12,000 you would have made with Project B. You're not making them now, you're going with A. And the opportunity cost of choosing Project B is the $15,000 you would have made with Project A. But you can't because you've chosen to go with Project B. Assuming all things being equal, you would probably choose Project A, since it provides you a bigger profit. In other words, Project A has a higher rate of return. So in this case, the opportunity cost of investing in Project A is $12,000, and the opportunity cost of capital is the rate of return of Project B. This opportunity cost of capital is the cost of a company's funds, or its rate of return that it could have earned by putting the same money into a different investment with equal risk, which in this case is the rate of return of Project B. So in summary, if you go with Project A, your opportunity cost is $12,000, the other project's profit. If you go with Project B, your opportunity cost is $15,000, which is the other project's profit. There's a lot of guesswork involved in this. Pick A, the opportunity cost is B. Pick B, A becomes your opportunity cost. Opportunity cost is forward-looking. You don't really know how the projects ultimately end up. So let's say you did both projects. Yeah, and a year later you see that the profits of Project A did not materialize. Project A's profit was only $8,000, whereas Project B did perform as expected with $12,000 in project. Now we can start to calculate this a little differently. The opportunity cost, if we had chosen Project B, which had an original opportunity cost of $15,000, is now only $4,000. That's $12,000 minus $8,000, but that's in hindsight. In hindsight, you realize you would have been better off with Project B. In this case, you would only talk about difference here because we're after the fact and you're no longer trying to decide which project to choose. But before, forward-looking, the opportunity cost is always the cost of the opportunity you did not choose. Now that you're an expert in opportunity cost, we can turn our sights back to our data center example. Remember that one? It had a lot of different opportunity costs we did not take into account. As a refresher, after 5 years, the cost to build the data center was at $2.635 million. That is compared to the outsourced option at $2.67, and so the decision was to build the data center because of the project's 5-year cost difference of $35,000. However, in that calculation is the assumption that there would be $180,000 in profit resulting from impressing potential customers by building the data center. This would not happen if you outsourced the data center. So the opportunity cost of outsourcing here is $180,000. You always use the next best option for calculating your opportunity cost. Maybe there was a third option, say building and owning the facility, but outsourcing the labor. This option precludes you bragging about hiring people, and it costs 2.69 million. Since this is a worse option than outsourcing, it would be considered in determining opportunity cost. To reiterate, the opportunity cost is the benefit you could have had by making another choice. And with all of that swimming in your head, I take the opportunity to wrap up part 1 of this lesson and look at the takeaways. Project costs fall into 4 quadrants that are the combination of fixed or variable and direct and indirect costs. These distinctions are important as they help ensure that you account for all the costs on the project. Identifying them as such sets expectations and helps you and others track them properly. Not all costs involve money changing hands. There is an implied cost in making decisions. When you decide between 2 different options, the opportunity cost is the cost of not taking the next best option. Opportunity cost is not about spending money. It is determined by comparing your choices to the next best decision. You are looking at 2 different, mutually exclusive options, and which has the best value. Money does not necessarily change hands. The opportunity cost helps you determine which option is best. It could be that a project is in trouble. Maybe it is over budget, behind schedule, or both, and you are looking at options. Calculating opportunity cost helps you make the decision. And that's it. See you in part 2. Until next time.